The Federal Reserve could cut interest rates to zero tomorrow, and the dollar might still go up. That sentence alone breaks basically every textbook you'd read in an intro economics class. Lower rates are supposed to weaken a currency. That's rule one. But there's a theory floating around Wall Street that says the opposite could happen, and if it's right, it means the next global financial crisis doesn't start with a weak dollar. It starts with a dollar that's too strong for its own good. It's called the Dollar Milkshake Theory, and once you understand it, you'll never look at currency markets the same way again. But first, you need to understand why almost everyone gets this backwards. For years, the mainstream narrative has been simple. The U.S. is running trillion-dollar deficits. The national debt is closing in on $40 trillion. The Fed has printed trillions of dollars out of thin air since 2008. Basic supply and demand says if you print more of something, it becomes worth less. So the obvious conclusion is the dollar is doomed. It's going to collapse under its own weight, and everyone should be buying gold, buying Bitcoin, buying anything that isn't a dollar bill. And look, that story isn't crazy. It's intuitive. It fits on a napkin. But it's also been wrong for over a decade. Because since 2008, despite all that money printing, despite all that debt, the dollar has actually gotten stronger against almost every other major currency on Earth. And the person who explained why isn't some random guy on Twitter. It's a hedge fund manager named Brent Johnson, and his explanation is the Dollar Milkshake Theory. Here's the analogy Johnson uses, and it's actually pretty clever. Imagine every major central bank on the planet spent the last 15 years pouring liquidity into the global economy. Cheap money, quantitative easing, near zero interest rates. Picture that liquidity as milk being poured into separate glasses. Japan poured milk into its glass. Europe poured milk into its glass. The US poured milk into its glass too. For years, everyone assumed all that milk sitting around would eventually spoil the dollar, dilute its value, and send investors running for the exits. But Johnson's argument flips the entire premise. He says the US isn't just pouring milk into its own glass. It built the biggest straw in the room, and that straw reaches into everyone else's glass too. So what's the straw? It's the depth, size, and liquidity of US financial markets. When the world needs a place to park capital that's safe, liquid, and always available, there's really only one option that checks every box. Not Europe, whose bond market is fragmented across a dozen different countries with different credit risks. Not Japan, whose government has spent 3 decades trapped near zero interest rates with a shrinking population. Not China, whose capital markets are still heavily controlled by the state and can't be trusted to let foreign money in or out freely. It's the United States. So when global uncertainty rises, when there's a war, a recession scare, a banking crisis anywhere in the world, capital doesn't scatter randomly. It rushes toward the dollar because the dollar is still the biggest, deepest, most trusted glass on the table. And that's the milkshake. All that liquidity everyone poured out over the last 15 years eventually gets sucked back through the U.S. financial system, no matter where it originated. And when that straw starts pulling harder, the dollar doesn't weaken. It strengthens, even while the Fed is printing money, even while the deficit balloons, even while every textbook says it shouldn't. Now here's where it gets interesting, because a strong dollar sounds like a good problem to have. If you're an American, a stronger dollar means cheaper imports, cheaper vacations, cheaper everything from overseas. But the dollar isn't just America's currency, it's the world's currency. And that's where the danger hides. Roughly $13 trillion of debt outside the United States is denominated in dollars. Not in euros, not in yen, not in the local currency of the country that borrowed it. In dollars. Governments in emerging markets, corporations in Europe, banks in Asia, all of them borrow dollars because dollar debt used to be cheap and because global trade runs on dollars. Oil gets priced in dollars, commodities get priced in dollars, international contracts get settled in dollars. So even a company in Turkey or Argentina or Indonesia that never does a single transaction with an American customer might still owe dollars to a lender somewhere. Here's the problem. If you're a foreign company and you borrowed in dollars, you have to earn your revenue in your local currency, then convert it into dollars to make your interest payments. That works fine as long as the dollar stays relatively stable or weak. But if the dollar spikes, your local currency buys fewer and fewer dollars. Suddenly, that loan that felt manageable becomes brutally expensive to service. You need more and more of your own currency just to make the same payment. It's like your mortgage rate silently doubling overnight, except you didn't even take out a new loan. The ground just moved underneath you. And when this happens across an entire economy, not just one company, but thousands of them at once, defaults spike. Currencies crash. Central banks in these countries are forced into an impossible choice. Either let their currency keep falling and watch inflation spiral, or hike interest rates aggressively to defend the currency and choke off their own economy in the process. Neither option is good. This isn't some hypothetical scenario either. We've watched this movie before. The 1997 Asian financial crisis. The 2018 emerging market currency crisis when Turkey and Argentina both got hammered. Every single time the pattern rhymes. Dollar strengthens, dollar-denominated debt becomes unpayable, and the country's currency and economy unravel together. So under the milkshake theory, the real risk to the global economy isn't a dollar collapse. It's the opposite. It's a dollar that keeps getting stronger, sucking capital out of every other market on the planet, and slowly strangling every country and company that borrowed dollars they didn't actually have. But here's where the theory gets its bite, the part that makes it more than just an interesting analogy. Because a strong dollar doesn't just hurt foreign borrowers. It eventually loops back and bites the United States too. Think about who actually buys American exports. It's foreign countries, foreign companies, foreign consumers, all of them paying in their own currency, which then has to be converted into dollars for American companies to actually collect the money. When the dollar strengthens, American goods and services become more expensive for the rest of the world to buy, even if the price in dollars never changes. A tractor made in Iowa that costs $50,000 doesn't change its price tag. But if the euro weakens against the dollar, that same tractor suddenly costs a European buyer significantly more in their own currency. So demand for American exports falls. American corporate earnings from overseas operations get squeezed when they convert foreign profits back into a stronger dollar. And on top of that, all those countries drowning in dollar-denominated debt start selling off whatever assets they can to raise dollars and make their payments, which often means dumping U.S. treasuries, the very asset that's supposed to be the safest thing in the world. So you end up in this bizarre feedback loop. The dollar strengthens because it's the safe haven. That strength crushes foreign borrowers. Foreign borrowers sell dollar assets to survive, which creates volatility in the very market that was supposed to be safe. And global investors, seeing chaos everywhere else, rush back into the dollar even harder because what other choice do they have? It's a spiral that feeds itself. And according to Johnson, it eventually ends in one of two ways. Either the Fed and other central banks step in with coordinated intervention to weaken the dollar before the damage becomes uncontrollable, or the pressure builds until something breaks. A major currency crisis, a sovereign default, a banking crisis somewhere in the world that's big enough to force everyone's hand. Now, before you go all in on this theory as gospel, it's worth mentioning the pushback, because there's a real counter-argument here. Critics point out that a truly catastrophic dollar spike would eventually become self-limiting. If the dollar gets too strong, it starts to hurt the U.S. economy directly through weaker exports and corporate earnings, which pressures the Fed to cut rates, which then takes some of the wind out of the dollar's sails. Markets aren't static. They adjust. There's also the argument that de-dollarization efforts, countries diversifying their reserves, new payment systems bypassing the dollar, could slowly chip away at the dollar's dominance over the coming decades, undermining the very premise that everyone rushes back to dollars in a crisis. The theory also doesn't have a clean timeline. Johnson himself has talked about this playing out over years, not months, which makes it hard to actually trade around or plan for with any precision. But here's why this theory has stuck around and why more people in finance are paying attention to it now than they were 5 years ago. We're actually watching pieces of it play out in real time. The dollar index has shown repeated strength during periods of global stress. Emerging market currencies have taken real hits during the same windows the Fed has been aggressive with rate policy, and central banks around the world have been stockpiling gold at record paces, which under the milkshake framework isn't just inflation hedging. It's countries quietly preparing for a scenario where dollar liquidity gets scarce and they need a backup asset that doesn't depend on anyone else's cooperation. And this is really the uncomfortable part of the whole theory. The two dominant narratives you hear about the dollar, that it's either about to collapse from money printing or that everything is basically fine because the Fed has it under control, both miss what's actually happening underneath the surface. The real risk isn't weakness. It's a currency so structurally dominant that its strength becomes destabilizing for everyone who depends on it, including, eventually, the country that issues it. So the next time you see a headline about the dollar being doomed, or the opposite, a headline celebrating dollar strength as some kind of victory lap for the American economy, remember that neither story captures the mechanism actually running underneath global markets. It's not about the dollar being weak or strong in isolation. It's about how a currency this deeply embedded in the entire world's financial plumbing can turn its own strength into the very thing that breaks the system it's supposed to protect. That's the milkshake. Everyone poured the liquidity. Only one country built the straw.